You're entering CNBC TV 18's virus-free studio, powered by Century Laminates and Century Ply.
Hey guys, it's the weekend and we're back with your favorite show, Smart Money. Now, every week we come to you with an offering where we talk about the top trending topics of the week and take up all of your queries. So first up, let me thank all of you for writing into us. We've got so many queries and we're going to try and address all of them today. But this week we thought, since we talk about trending themes, let me pick up a theme which has the word trend in it. Trend investing is what we're going to discuss in today's episode. What is trend investing and how to create wealth using trend investing tools? Now, the reason we picked this up is because if you had used simple trend investing tools at the end of March, you would have been able to create a lot of wealth in this market. And we have nobody but ACE technical expert Atul Suri, ACE trend analyst Atul Suri, let me be precise, to join in and give us his view on understanding this theme and taking up all of your queries. Here he is. Atul, hi, welcome to the show. Seems like you're already weekend ready.
Hi. Yeah, I guess these are good days, you have the freedom to dress. If you have some client meetings, etc., it's just wearing the white shirt. Otherwise, a t-shirt and a pair of shorts, it's just perfect.
Okay, perfect for the mood, right? Setting the mood for our show. But, just let's get straight down to the basics. We're going to talk about trend investing. And we've got so many queries on this. So just to understand what trend investing really is, I mean, if you go by the theory, then it is a stock that moves higher will continue to move higher. So you latch onto that stock. Have I read it correctly, or is it as simple, or is there more to go?
No, I think it's very nicely and simplistically put. It actually comes from one of Newton's laws of motion. But let's understand what a trend is. A trend is nothing but a direction. So in our markets, we broadly have three trends. We have an uptrend when the markets are going up. You have a downtrend when the markets are going down. And you have a sideways trend when markets and stocks are doing nothing much. So for an investor, ultimately, whatever your tools are, you are looking for an uptrend. It's as simple as that. You want to buy a stock and hope that the price goes up. For a trader, a down market is great because you can short sell. And sometimes people also play volatility, and you can short walls and also do well in a sideways market. But for purpose of this program or for this show, let's just stick to the long side, which is really buying a stock and hoping that the trend or direction is up and being able to sell at a higher level. So that in simplicity is what really trend investing is. And if you ask yourself the question, that's what all investors do. That's what all investors want. So in what way is trend investing different? I mean, what's so special about it? So what is trend following is nothing but another derivative or term for trend following. I use the trend investing, I'll explain to you later. But what a trend follower or a trend investor does is that his job is to find a trend. And markets globally, there is always a trend. If it is not in equities, it could be in some other asset class. If it is equities, you'll find that some sectors have better trends, some sectors don't have trends. So as a trend investor, my job is ultimately to look for a trend, because money is made in trends.
All
it's
right.
that simple as that.
Okay, so let me just take this point forward, Atul. Suppose you find a trend. Okay, you've identified one trend in say a particular stock in a sector. How do you put your risk management in place? How long do you stay with that trend? When do you exit? What are the do's and don'ts?
So I'll just take a step back and finish what I was saying. Was that actually trend investing, most people associate it to be very quantitative. It has something to do with price. But as I look at it, we really use a combination of fundamentals and quantitative. So the style of investing that I use is called quantamentals. It is a combination of quantitative and fundamentals. Now coming to your question about, how do you allocate money, what is the risk, etc. So as a trend investor, really very often the allocation per stock is equal weighted. When you are driven by emotions and you have likes and dislikes, you give a higher weightage or lower weightage depending on your conviction level. But as a trend investor, really you do not have likes and dislikes. The greatest advantage or the greatest plus point of trend investing is the moving away of emotion. So when you don't have emotion, you don't like something more or you don't hate something more. So that is why in the whole allocation game, we actually allocate equal amounts to every investment, because as a trend investor, you do not know which of them is going to be a monstrous trend. And in that sense of the term, it is very quantitative. So the whole game is about cutting your losses and riding your profits.
Okay.
That is the basis. That is real basis. If assuming we have 10 bets, not all 10 are going to work. Even among the best of investors, maybe 5 or 6 work. But the key thing is to lose as little on the 4 or 5 that you're wrong in and to make a lot more. So that also brings us to the question of risk reward and so on and so forth. So trend investing is a combination, as I see it, the way I use it, between fundamentals and quantitative, which is a style called quantamentals, and it works on the basic simple principle of cut your losses and ride your winners.
Okay, so we are getting a lot of queries right now, a lot of people writing into us about trend investing, the mistakes that they have perhaps made. But before we get to that, you want to share any example with us, perhaps a stock that you picked up based on trend investing tools and which had worked for you in the past?
So as a trend investor, our objective is never to buy at the bottom and sell in the top. Because as the line goes, that tops and bottoms are made for fools and liars. And having spent about 30 years in the markets, I've realized that one big fallacy is to pick the bottom. It is all good and knowable in the future. Oh, here was the bottom. But when you are there, it's like, people say, oh, great returns from March. But when the Nifty was 7,500, it may be a good point, talk about, but how many people invested? So the fact is that tops and bottoms, I think, are for fools and liars. We are, as trend investors, a little late in the trend. We never even sell at the top. We don't even try to predict the top. We may sell a little late. The objective is to catch the meat in the middle. So let me give you an example of a stock. I think it was 2015 or so, was a stock called Eicher Motors. So Eicher Motors had actually moved to around 1500. So as I said, I didn't buy the stock when it was 5 rupees, 10 rupees. I mean, I don't have that ability. I'm not so smart. But the fact is, by 1500, it was very clear that here was a company which was consistently giving out great numbers. Whether it was top line, whether it was operating, bottom, return ratios, cash flows. So you really had an immaculate fundamental performance coming in. Along with that, you also saw excellent quantitative behavior. So what I really saw was that as the markets corrected, or when the markets corrected, Eicher actually hardly corrected. And when the markets turn around, it was the first stock to move higher. So I work on the principle that stocks that fall less in falling markets are the winners of the next bull market. So I picked up Eicher around 1500. In about 2.5 years, it went all the way to 30,000. So that was quite rewarding. It was almost 20x. But as I said, I don't know where the top is. It was 30,000. It was great. I never really sold it at the top. I sold it much later at around 26,000. What you realize was the opposite. The top line, which was growing at a very robust rate, massive waiting lines at stores, actually had flattened out, and growth had flattened out, earnings was narrowing, and what you really saw was that the change in trend in prices. So as I said, I sold it at 26,000. I didn't buy it at the bottom, I didn't sell it at the top. But the beauty is that the ride from 1500 to 26,000, which happened in very good time, about 2.5 years, was fantastic. So trend investing is not about catching the bottom, not about the top. It is being able to get the meat in the center. And
Absolutely.
Always the meat in the center is very sweet because it's fast, it is swift.
Okay, so that's going to stay with me. Tops and bottoms are for fools and liars. But you don't have to be so modest, Atul. I mean, buying a stock at 1500 and selling it at 26,000 is a big victory in itself, whether you catch the bottom or not. But we have a lot of queries coming in, so let's go straight to that. I think we have a gentleman joining in. Shyam Agarwal is with us. Shyam, go ahead. Tell us your question.
I've noticed that market participants invariably believe that multi-baggers need to be necessarily identified outside the status quo trends. In other words, trend investing is mistaken for herd mentality. I want to ask you, sir, to what extent does this narrative hold ground? Also, how imperative is the risk-reward model while one is trend investing?
All right, thanks Shyam for that query. Atul, go ahead, your advice to him.
Yeah, that's a good question. So as I explained with my philosophy earlier, that as a trend investor, the superiority of the process is about very good risk-reward ratios. In other words, that when you cut your losses and ride your profits, you'll realize that even if your strike rate is not even 50%, you still, by the mathematics or the statistics of it, come out as a winner. And this happens with low volatility. Now the issue is that one big emotion that drives a lot of people is ego. And the greatest ego trip is that if I picked a stock at the bottom, and then the stock really takes off. So for me, I don't really have any such ego. So that is why what I find is that, yes, trend investing is not so sexy. It's not such an ego trip because you really don't buy at the bottom. If you buy at the bottom, yes, if you get some of your calls right, they become multi-baggers. But as I said, I am okay to take the midsection. Because the fact is that if I can consistently get the midsection with low risk, that is a crucial thing. With low risk and a higher strike rate, I'm happy to do that. Because in that case, my equity curve is a beautiful 45 degrees. In multi-baggers, we look for 90 degrees. You may get some right, but you can get very many wrong. And that kind of volatility that you experience, or that kind of emotional churn that you experience, is something which is not for me. So at the end of the day, even that style is good, even that style is good. The crux of any investment style is that it has to fit your personality. And for me, over years of trial and error, we all do that. We're all looking for the perfect system, perfect indicator, perfect ratio, perfect blah, blah, blah. But there's nothing perfect. It's all imperfection in relation to yourself. So this really suits my personality. I am one of those guys who likes multi-year consistent compounders with low volatility, because that's how I have seen wealth is created, and probably that's where my inner being is. That is why I like trend investing, or the philosophy of trend, rather than looking for penny stocks which are multi-baggers, because that has a lot of volatility and it's not good for my emotional quotient.
Okay, it's not good for your blood pressure or stress levels as well, right? I'm going to talk a little more about what the characteristics and tools are of trend investing. But we have another viewer joining in with his query, so let's go straight to him. Anik Pal is with us. Anik, go ahead. What's your question?
I have started equity trading around 5 to 6 months back. So my question is, if I want to do some trend investment in some particular stocks, what are the things I should look in that particular stocks? Also, as of now, I can spend around 5 to 10,000 in stock market per month. So I am looking for stocks which is having price below 100, so that I can buy at a large volume.
Okay, thanks a lot, Anik, for that question. So Atul, what are the 2 or 3 things that you have to look out for while trend investing and picking up stocks? So that seems to be his, basic question.
Yeah, so essentially he is coming with a modest capital, so he may actually be in a bit of a rush. So I think the first investment he should make is in knowledge, because also when you're early in your career, that's one of the best times to go out and acquire knowledge and sort of explore the various investment styles and paradigms there is. So it's not that, okay, just because, sometimes small caps work, people say small caps, sometimes large caps, then you're going to trend investing. So I would actually invite you to really take a step back. I presume you're early in your career, and I think you should spend time on education and understanding the market. Irrespective of that, I think that the tools that you have to look at is not going to come from me. I am not going to recommend a stock, because even if I recommend a stock, and I have seen that with great investors, is ultimately it is your personality that fits into it. So trying to recommend a stock, a sector, or an industry, or an indicator is actually useless. That is why I feel that this whole game, when people ask for tips and recommendation, doesn't work. What is not linked to this recommendation is your personality and your ability to make money. So I wouldn't really recommend a sector or a stock to you. I can do that in the current market context. I can talk about pharma as a sector, specialty chemicals. As a disclaimer, I'm overweight in my PMS in those areas. But I generally think that looking for recommendation, and that's a very sweeping statement I know I'm making on a TV channel, But rather than that, I think spend on education, discover a style that suits your personality. It's taken me many years of lot of trial and error to ultimately find a strategy or style that fits my personality. And that is what makes me a trend investor, not just intellectually, but even emotionally.
Absolutely.
And once you have a sync between emotion and intellect, then you'll find that you reach a state of Zen.
Okay, yes, that's what we want to learn, right? How to reach that state of Zen. But many more questions for you, Atul. We need to take a short commercial break. Don't go anywhere, guys. When we come back, we'll discuss more themes. We'll also talk about what are the returns that you can generate using trend analysis and answer a few more queries and a special rapid fire segment coming up in just a bit. Welcome back. You're still watching Smart Money on CNBC TV 18. We've been talking about trend investing. Atul Suri is our guest. Atul, before the break, we were discussing about the benefits of trend investing. But I had two questions for you before I toss it across to our viewers who've written to us with many queries. One is, has history taught you that trend investing gives you better returns than conventional stock picking? And two, does trend investing get affected by any economic changes?
So the fact is that returns, as I said earlier, is that the tools are there. Ultimately, it is the person who uses it that's what really matters. So it's such a beautiful quote that I remember from Morpheus, in Matrix, where he speaks to Neo and tells him that we all know the path, but walking it is the challenge. So really, like everything in investing, trend investing, yes, would give you superior risk returns. The good part about trend investing is that it is less volatile. So when you look at returns, you just can't look at returns in an absolute number. You have to also look at volatility. So if you are looking for a low volatility portfolio which consistently compounds, I think trend investing is a very superior and a very appropriate technique. If you're looking for vertical moves, if you're looking for doublers or stocks that go up into circuits, then probably trend investing is not for you. So trend investing is not good for maybe quick short-term money making, but if you're interested in compounding money with low volatility, I think trend investing is very, very suitable. And the beauty about trend investing is that it is not rocket science. It's pretty simple in that sense of the term. The challenges of trend investing are the principles of discipline, which can never be compromised. The success or application of this, or the secret recipe, secret sauce, secret of success, if you say, as a trend investor, is ultimately your discipline. And that is something which is got no, I would say, compromise if you are a trend investor. So it gives you superior returns, yes. It gives you superior risk adjusted returns, yes. But one thing you should not compromise, and that is discipline. And that is, I think, what is very important to trend investing.
All right. And I think that is what we're going to be telling a lot of the viewers who write into us as well, right? So many of them are young investors and want to know what are the key pearls of wisdom. So we have another one who's joining us now. Vedang Krishnan is with us. Vedang, go ahead. What's your question for Atul?
I want to ask that out of the three, equity traded funds, mutual funds and index funds, which one would be better for a long-term investment considering the percentage charges which they apply, and how those percentage charges would affect my returns in the long run?
Okay, Atul, any advice for him?
So the big thing that is happening globally, especially in the US, is the whole passive index investing. And what has happened is that as US has over the years matured into a more perfect market, fund managers were unable to beat the index. And when fund managers are unable to beat the index, you'll realize that post-cost, they get inferior returns vis-a-vis the index. And that is why the whole move has happened towards passive, which is index investing. The attraction of index investing is, yes, you participate in the market, but your cost is very low. However, if you look at the Indian context and if you look at how mutual funds and PMSs have done, you'll find that over a longer period of time, which is 3 years to 5 years, most have beaten the index. And that is post-cost. So just because indexing is working in the US does not mean it is the best option in India also. It's a nice catchphrase, there's a lot of talk about it, but as long as fund managers or asset managers are able to outperform the index post-cost, I think mutual funds and PMSs are a much better option.
Okay, mutual funds and PMSs, especially if you're a young investor, I think that's the route to create wealth. But we've run out of time, but as tradition goes in Smart Money, we do a quick rapid fire. So a couple of quick questions coming your way, Atul. First question, you read a lot, as everyone can see. You have this massive library behind you. What is your favorite book on trend analysis?
My favorite book of all times has been a book called Market Wizards by Jack Schwager, and that's the first edition. Because to some extent through that book I discovered my mentor Ed Sikota, who's one of the wizards that is featured there. So for me that book has been a very, very big influence.
What is the biggest market lesson or learning from his life and his work?
So I think there are a lot of quotations. I was very fortunate to connect with Ed, get to know him. I was part of a trading tribe in Mumbai. In fact, I went to Cambridge and attended a 4-day workshop with Ed. So through this book, I was able to connect with one of the great market wizards. And there's a lot to learn from Ed in terms of life and markets. So I'll give you 2 quotations. For life, he says that ultimately in life, we all get what we want. And this is really working at the subconscious level. You can talk, read a lot about it. And the second is that the trend is your friend till the end when it bends. So ultimately, it's about being aligned with the trend. The only time it doesn't be your friend is when it bends or when the trend changes, and that's the time to sell, and that's where the discipline of selling comes in.
Okay, the trend is your friend till it ends when it bends. Okay, well that's a tongue twister, but I'm going to remember it. What about Twitter? I mean, it's all digital these days. Which is the one Twitter handle you love to follow?
There's a guy called Naval Ravikant. So he's of Indian origin in the US, very big in the VC world. I find Naval to be a great capitalist philosopher, because generally philosophers tend to be more religious or leftist, but he's a great, very, very inspiring young investor who's a great philosophical mind. So I call him the capitalist philosopher. So I really follow Naval Ravikant very closely.
Atul, you know, these are very challenging times for all of us, right? How do you tackle stress during this COVID time?
So the discipline of physical and mental health is very important. So, you know, I have a rule in my house that we shut our computers at 6, because the moment we wake up and markets all day and calls and Zoom calls, etc. So I have a rule which is really shut your laptop at 6, and that's a time when we really go out. We've been very fortunate that we have a nice seafront opposite our house, so we generally often go, of course, do social distancing, wear masks, not catch up and talk to people. And now the best part is cycling. So I've really taken up cycling. Cycling is a great way of social distancing, because even if you know somebody, you can't chit chat, you've got to keep distance. So I have been cycling a lot, and a lot of hills around my house. So, you know, it's pretty good, waterfront, hills, very challenging. So I've been keeping fit mentally and physically through cycling at the moment.
We can see that. We've managed to get hold of a picture of you cycling, and you look pretty damn fit, so continue with that. Let's get back to talking shop then. What's been the best stock buy of your career?
I think at the moment it is DV's. It's doing pretty good. Again, a stock I bought about 3 years ago. And fortunately the whole, 3 years ago pharma was actually in the dumps, and only one pharma stock or 2 pharma stocks were doing well, and one of them was DV's. And now you find that the color has come back to the whole sector, and this has pushed the stock higher. So again, I have a vested interest. It's a part of my PMS. And another example we spoke about earlier was Eicher Motors. I think that also was a beautiful ride for me. So I really like consistent compounders. I like stocks that, you know, have 45-degree angles and just go on till infinity. To some extent I may be considered as a lazy investor, but I don't like too much volatility and too much spikiness. If something moves at 45 degrees, I just love such stocks.
Okay, and which is your biggest investing mistake that you'd want young investors to avoid?
I think it was clearly in the year 2000. The stock was Mastech. I remember that it was a very big IT bull market, and when the market corrected, it again bounced back. And I had exited very well, but I bought a stock called Mastech. And when the market corrected next, my stop losses had to be triggered, my risk management had to be triggered. But since we had made so much money in IT, I got complacent, and I didn't sell the stock when I should have sold it. And post that, I saw the stock go into 16% circuits. You know, we had 8 and 8, 16% circuits. I think it went for 5 continuous downside circuits. And I remember losing 30% of what I had made in the whole bull market in one stock. And that pain never left me all my life. That's a learning which is about exit. It's the pain about not missing, or the discipline of having your stop losses. Because I feel that, especially for a lot of young traders, if there's only one thing I want to leave with you, is the discipline of cutting your losses. Because at times it is painful because you cut a loss and the stock goes up. But there will be a time when markets turn big time, and it will make sure that it still keeps you in the game. It's not about hitting a 6 of every ball. You can also take a lot of singles, but the important thing is don't lose your wicket. And the only way you cannot lose your wicket as a trader, which most of you may be, is to have a discipline of a stop loss.
Okay, Atul, on that very wise note, thank you so much for joining us on Smart Money. It was a pleasure speaking with you, learning from you more importantly. With that, guys, it is a wrap on this episode of Smart Money. Keep sending in your queries and we'll be back same time, same place next week with a brand new trending theme for you. Thanks for watching.